Okay, this is going to be video 2 of the Back to the Basics trading series. This video is going to be about risk management. We're going to quickly talk about the entry, exit, stop loss, our risk to reward, but we're going to spend most of our time talking about how your stop loss determines your position size and knowing when to hold them or when to fold them. Basically, you take 25 trades with your system and you use the results of those 25 trades to determine if your system is actually valid, because you don't know until you try. So real quickly, if you have a trade, you have to buy, you want a stop loss, you want something to cut your losses if price goes against you. You need some sort of invalidation. That's always important, and that is always important, and you want every good trade has an invalidation point. At the very least, you need to have an idea of, like, hey, I'm capping my risk at this amount because that's how much I'm willing to lose. I mean, you're gonna have losing trades, you're gonna lose money. It sucks, but the smaller the amount of money, the less bad that is, obviously. So, you're entering the market, so that's your entry, and you want to stop loss because that's invalidation. That is cutting your losses. But you also want an exit, and where your exit, what your exit is going to depend on, your strategy. But you usually want, you're gonna want, if you're watching this video, you're probably gonna want at least 3R or 5, probably max 7. But then you also, what we'll talk about towards the end, is that you're also gonna probably want to take partial profit at like 1.5R or 2R. And we'll talk about that. We'll talk about that now. We're talking about R. So it just works. If you forward test any strategy or back test any test any strategy, forward or back test, taking partial profit, it usually works pretty well. It works in your favor. Not only are you taking off risk, but you're securing profit, which is like doubling your taking off risk. So it's a good thing to do. If you have a position, and your trade is your target, target R is 4, and it means your stop loss is one of those R. So say, I don't know, 1%, you have a 10% stop loss. Price can go 10% against you, and that's when you're going to cut your losses. Your target is that price goes in your favor, 40%, and then that's what you'll cut. Cut 100% of the position. If you take profit at 20%, so you have $100, it goes up 20%. Now you have $120 in your trade, and of that you're going to be risking 10. You take profit, half profit at 2R, that's 2R. You take $60 off the table. Oh. And you're letting 60 ride. And you want price to go up another. So now we have 60. You started with 100. We got 60 out and 60 in. And it goes up another 20%. So, sorry. You have $72. And that's when you're gonna take it out completely. Now you have $132 instead of your $140. So your actual end of the day R is 3.2, but it's good. I mean, you capped you also had after you took your 60 out, your risk compared to your original position was 0.5R, so that your risk to reward ratio was actually better than 4-to-1. It was, I don't know, whatever this is, 6.4-to-1. So in the grand scheme of things, you end up being more successful with most strategies if you take half profit at halfway to your target. It usually works out good because when you're actually trading, you'll realize that price goes in your favor very often. Usually you're generally right, but you're also usually not as right as you think you are. So that's where this whole thing really can help. So that's just some discussion about R. The important thing I want to talk about is how stop loss determines position size. And that's position, boop. Where can I go? We're going to go down here. Ooh. Stop loss determines position size. So how much money you put in a trade, what percentage of your portfolio, what percent of trade capital you use on a given trade. Because this is the secret of how you actually manage risk, and it's not a secret, but this is what it took me a while to stumble upon this concept. It sounds super simple once you actually start implementing it and hear it and all of that, but it took me a while before I actually had someone explain this to me like I was 5 years old, because that's what I needed to start doing this. So you have a trade. We're going to do another imaginary trade. You want 4R. You have your invalidation is 10% price movement away from entry. So that doesn't mean if you have $1,000 that you're willing to risk $100 on this trade. No. What you want to do with your trades, if you're actively trading, is you want an overarching goal of a fixed percentage. In this case, we're going to say 1%. You can determine this percentage on your own, but I strongly recommend 1%. So we're just going to continue with this. A goal of 1% max loss per trade. And that's 1% of total capital. And this is what I use. Every trade I take, I'm only risking 1% of my entire trading account. That's not my entire net worth. That's not the entirety of what I have in brokerage accounts. That's on that single trading account. Yeah, so how do you do that? If your stop loss is 10% away from your entry, you use 1/10 of your trading account. So, I have $1,000 trading account. Stop loss is 10% from entry. I want to max risk $10 of total capital. So I only used $100 of account in this trade. Now, this is difficult for traders starting out, usually because, okay, if I only use $100 of my trading account in this trade, okay, yeah, my max risk is $10, but also my max reward is only $40. And people like, I'm never gonna grow a trading account making $40 a trade and all that shit, but $40 on this trade is a 4% increase on your trading account as a whole. So like, yeah, $40 isn't that much, but if you have 10, or let's even if you just have five winning trades, net wins. So whatever you take, what you would need 10. So let's say you had 10 trades. We'll do a fake number. 6 wins, 4 losses. So of your 6 wins, you made $240. Of your 4 losses, you lost $40. Assuming that, we're still using this example here. So, yeah, this is all of your trades for the year. You only made a net of $200. That's 20% on your total trading account. Now, no, you can't quit your job making $200 a year, but you can quit your job making 20% a year. If you do that year after year, you keep investing into your account, you compound on your account. If you can make 20% a year, year after year, you can get outside capital. That's not something I ever suggest. I don't think you should do that. Most people shouldn't do that. But it's an option. So, yeah, I don't know. This is just how it is. If people have questions, I can talk about it more, but I don't want to drag this out too much. The last thing we're going to talk about is knowing when to hold them versus fold them, 25 trades. We're going to do that over here, but we're kind of going to build off of this. I'm not going to write all that out. So, you have 25 trades. You're trying to figure out if your trading system actually works. Whatever, your rules for finding trades, entering trades, getting out of trades, if that actually works. You should be able to know that within 25 trades. And that's 25 trades. This is from Mark Douglas, I think. I feel like it's kind of an arbitrary number, but it's a good number. There is some statistical whatever. If you remember statistics class in school, there's some validity behind a sample size of about 15 to 30, and 25 is kind of right in the middle there, sort of. So 25 trades is just a good rule to go by when you're forward testing a new strategy. In this, using this example, 25 trades, you lost 25 trades. We're only risking 1% of our account size. You're down $250. You're down 25%. That's not that bad. Like, being down 25% for the year obviously sucks if you did lose all these trades. The point is not that you need to lose all these trades to say your trading system is invalid. You need to lose 4-to-1 win ratio. You need to lose like half, more than half of the trades. You need to lose about half of these trades. If you lose half of these trades, you got 5 wins times 40, 5 losses. I mean, if you lose half, you're still sitting pretty good, to be honest with you. You're still 15% a year. So that would be fine. If you start to lose more than half, maybe it's not fine. Like if you had, so these are your wins, these are your losses. If you had 4 wins and 6 losses, now that makes a big difference. So because you got 160 versus 60, now you're only made $100, which is 10%. 10% isn't that great. You probably could have just been invested in SPY. Now, if you made 10% when SPY tanked 20% that year, then maybe it's a good deal. But you do want to have this compared to market weighted results. But let me try to go over this quickly to make sure that I'm being clear. But you only want to risk 1% of your trading account. You only want to risk 1% of your trading account per trade, which means if you have a stop loss that's 10% away from your entry, you only want to use 1/10 of your trading account. As you're executing on your trading system, you're going to give yourself 25 trades where you can take, as long as you're following your system, you just take the trade and you see at the end of your 25 trades what the results are. You know, if the market is going up 10%, like S&P 500 is doing its average of plus 8/10% a year, then having half wins, half losses isn't a bad deal. Once you get to having 4 wins and 6 losses, it maybe is less attractive to have a 10% increase in your trading portfolio if this S&P 500 did go up 8 or 10% a year, because yeah, 10% is more than 8% from the S&P 500, but it is you had to work a lot harder than you would have if you were just invested in the ETF or whatever. So that's why you want to end up comparing market weighted results. But that's kind of the gist of it. It's a simple overview. We are trying to keep things simple here. I hope it was clear. If you have any questions, you can figure out how to ask those, and I'll try my best to address them. Thank you.